Warren Buffett's worst investments of all time. Hey guys, today we're going to list Warren Buffett's worst investments of all time. Let's get right into it. Number 1. Dexter Shoe Company. Dexter Shoe Company was purchased by Warren Buffett Berkshire Hathaway in 1993. Buffett describes it as the worst investment he has ever made. Buffett made more than one big mistake when he bought Dexter Shoe Company. The first error was a misunderstanding about Dexter's prospects. Berkshire purchased Dexter because of its high return on capital employed. They did not, however, account for the competitive threat posed by cheap shoes from countries such as China. In 1999, Buffett made a note of it. He wrote that it was becoming increasingly difficult for domestic producers to compete effectively in the shoe industry. This is because approximately 93% of the 1.3 billion pairs of shoes purchased in the United States came from outside the country. So the first lesson is that before investing in a company, you must access its long-term competitive advantage. Long-term competitiveness is no longer a desirable trait. It is an essential component for any business. Buffett's second blunder was not paying cash for Dexter Shoe Company. Instead, he invested $433 million in Berkshire Hathaway stock. In 1993, one Berkshire Class A share cost around $15,000. It is now worth $517,000. As a result, the Dexter acquisition did not cost Berkshire shareholders $433 million for a company that eventually became worthless. That blunder cost Berkshire shareholders a princely sum of $15 billion. As a result, the lesson is to never sell your winners in order to make risky bets. Number 2. Tesco. Tesco is a grocery store chain based in the United Kingdom. Berkshire Hathaway owned more than 5% of the company by 2012. By 2013, it was clear that something was wrong with Tesco, and Berkshire had reduced its stake to 3.7%, representing a nearly $1.7 billion investment. Tesco's share price continued to fall over the next few months. It dropped nearly 50% as a result of declining sales and increased competition from discount retailers. There was also an accounting scandal going on at the same time. In addition, the company was being investigated by the UK's financial regulators. Buffett's blunder was delaying the sale of Tesco stock, and he did so despite having seen the warning signs. As a result of the delay, Berkshire suffered a $444 million loss. As a result, the lesson here is that conviction is also essential for selling. Just as you wouldn't invest without conviction, you shouldn't hold on to a stock if you don't believe in it. Number 3. Energy Future Holdings. Warren Buffett almost never makes an investment decision without first consulting Charlie Munger. However, he revealed one such error in his 2013 letter. Buffett paid $2.1 billion for Energy Future Holdings Corporation bonds. Unfortunately, it also turned out to be an $873 million mistake. Energy Future Holdings generated electricity using coal-fired power plants. Buffett's purchase of their high-yielding bonds in 2007 was a bet on the rising price of natural gas. As a result, the coal industry will become more competitive and profitable. However, natural gas prices have fallen since 2007. It resulted in massive losses for Energy Future. In the end, the company declared bankruptcy in 2014. Berkshire eventually sold the $2.1 billion in bonds in 2013 for a loss of $873 million. Warren Buffett admitted humbly that he had miscalculated the transaction's gain-loss probabilities. He cited a lesson in which it is always beneficial to seek a second opinion. When making major decisions, you can seek advice from a business partner or a trusted confidant. There are a few more takeaways from this episode. The first is the risk of predicting something, particularly the price of natural gas, oil, gold, or even a single stock. The second takeaway from Buffett's blunder is the value of investing in high-yield junk bonds. Berkshire Hathaway is a massive corporation. It can afford to lose some money in order to pursue such high-risk, high-reward opportunities. A default like this, on the other hand, can be financially disastrous for retail investors. In that case, you should try to avoid instruments with a low return on capital. Number 4. Lubrizol and David Sokol. Warren Buffett and Berkshire Hathaway came under fire in 2011. Buffett Lubrizol Corporation was proposed as a potential takeover target by David Sokol, chairman of many of Berkshire's subsidiaries, but he did so while holding stock in Lubrizol Corporation, a chemical company. Mr. Sokol's failure to inform Buffett of his stock ownership violated Berkshire's insider trading policies. And while Berkshire acquired Lubrizol for approximately $9 billion, David Sokol profited from the transaction to the tune of $3 million. According to Berkshire's internal investigation, Sokol was purposefully vague about how he came to own the Lubrizol stock. Sokol did not state that he purchased the shares only after meeting with the bankers who presented the acquisition proposal. In Buffett's own words, it was a simple matter of ethics. But it was only after admitting that no one was to blame that he made this statement. Both David Sokol and Warren Buffett made mistakes in this case. And the investing lesson to be learned here is to be cautious. Make a checklist, adhere to procedure, and don't be afraid to ask more questions than you think are necessary. You cannot afford to be sloppy when your reputation is at stake. Number 5. Amazon. Buffett admitted in 2017 that he had long followed Amazon.com, but had never chosen to invest in it. In his own words, he said, "I was too dumb to realize. I did not think Jeff Bezos could succeed on the scale he has." Buffett had underestimated Amazon's ability to execute in 2 industries. One example is the company's e-commerce dominance, and 2, its cloud success with Amazon Web Services. The takeaway here is one of compatibility and evolution. That's all for today, and we'll be sure to catch you all in the next one.